Hi, everyone. I'm Rick Bensenor. Today is Tuesday, July 19th, and welcome to this week's In the Know Trader Show. What do we have on tap? Well, the topic of the week is going to be a simple one, and this could be potentially even the shortest video I've done in a long time, but it's probably one of the most important topics to discuss if you're going to be a successful trader. And the topic is: stick with your trade until the news changes or price proves you wrong, not because you're impatient. That's what I want to talk about. Before we do that, let's get to the products that we offer at In the Know Trader. We have 3 different written reports, each one with a different time frame. We have a daily tip sheet. This is a report that comes out daily, fills you in on what you need to know about the market, what you need to expect for the coming day, as well as the key levels in the S&P 500 that we're keying off of. I also give you a brand new trading idea multiple times a week. So we generally have a whole bunch of open orders or trades on at the same time to help you up the results of your trading account and get you more into some of the shorter term opportunities that exist in the market. Secondly, we have a weekly ETF Tactical Trader Report that comes out generally on Thursday evenings. This gives a broad macro background to everything going on in the markets. We'll look at all the key influences to what pushes the stock market around from the other asset classes. So we looked at the bond market and credit spreads and the US dollar and gold and oil and anything that is relevant to interpreting the macro picture in order to better play the medium-term time frame for stock investing. I'll also give you a brand new ETF trading idea each week, as well as review each and every open position we have until it gets closed out. Again, that comes out Thursdays. That's the weekly ETF Tactical Trader Report. Then I have something called 7-Eleven Report. This is a monthly report, and the goal of this report is to outperform the S&P 500 by being in no more than 7 of the 11 SPDR macro ETFs at any given time. There are 11 sectors to the market, like financials, energy, consumer discretionary, technology, industrials, etc. All 11 of those sectors in their proper weighting gets you the same return of the S&P. What the goal here is to be in no more than 7 of them to try to avoid the underperformers in order to outperform over time. And how have we done with that? Well, here are the official results. Through June 30th, last year we outperformed the S&P by just over 6%. This year has been a tough year for any portfolio manager to get ahead because there's only a few stocks that have led the market. We are still outpacing the S&P by 32 basis points, but most importantly, over time, which is what this is really about. Instead of just simply owning SPDRs in your account, if you were to follow my recommendations at the start of each month as far as which sectors to be in and how much weighting to each one of those sectors, you would be ahead of the S&P's return since August 1st, 2020, when I first started this report, by a whopping 14.21%. On a $100,000 account going back to August 1st, 2020, you would have an extra $14,210 in your account instead of what you would have simply by being in SPDRs. That's virtually unheard of in the managed money world when you're talking about not a hedge fund, but something that simply is playing the S&P itself. It certainly puts us in the top 5% of all people who play this game. So if you have money in SPDRs or Qs, but certainly SPDRs, and you're not currently subscribing to the 7-Eleven report, I suggest that you check it out. Now, all 3 reports come with 7-day free trial. So if you sign up, We will not charge your credit card until 7 days after you sign up. This way, you will have access to everything we've done through a name and login that you create, and you can see past reports as well as get anything new that comes out over those 7 days. So I highly recommend it to you. And what I do also is give you discounts for signing up for multiple reports. So not only can you get a discount for signing up for an annual subscription, which gets you the free 7-day trial, but you get a substantial discount over paying month to month when you sign up for an annual subscription in a one-time annual fee that's greatly reduced cost compared to 12 months worth of the monthly cost. If you sign up for more than one report, you also get discounts for signing up for multiple reports. So that is by far the best thing to do. It does commit you into the time frame in the sense that if you take an annual report subscription, you can cancel after your 7 days, but you lose access and you've already paid. But for those who know that they want to continue to get my services, and I will tell you that about 2/3 of all subscriptions are annual subscriptions, because once people join me, they realize they want to stay with me for the long run. You get the best deals by signing up for annual subscriptions and multiple subscriptions. Subscribe to my YouTube channel. That's youtube.com/inthenowtrader. If you do that, then each time you log into YouTube, my most recent video will be on that homepage that shows up for you. And of course, I occasionally tweet. So go to Twitter and follow me at InTheKnowTrader. So let's get back to this topic of the week. Stick with your trade until the news changes or price proves you wrong, not because you're impatient. So the way I want to think about this is when you put a trade on, I assume you've done some homework beforehand, right? Because we don't just throw things on without figuring out why it is that we're doing what we're doing. So let's assume we've done all the work that we need to, and you decide, let's say, to buy stock XYZ, and you put in a sell stop underneath, whatever, whether it's a percentage or a dollar amount that you're content with, but that stop should be based on something that's meaningful, such that if the market were to sell off down to that level and you get stopped out, the odds are much higher than random that that stock is still going to trade lower. In other words, you want to put your stop in at a place that if you're stopped out, it's there because you think the game has changed, and therefore you no longer want exposure to that stock, as well as the thought process is that you do believe that stock is going lower. However it is you come up with your sell stop, once you buy the stock and you have your sell stop, if a few days go by and your stock is not responding in the way you'd like it to, so in the example I gave, it's not going higher. In fact, maybe it's gone against you a little bit. I would tell you to stick with your trade idea and not let your head and your impatience talk you out of the trade just because it didn't happen to go up as soon as you bought the stock. As long as the news on that stock or ETF or whatever it is that you've invested in has not changed such that it would change the opinion of why you'd want to own that name, or price hasn't violated your stop out level, don't let your head talk you out of being in something simply because it hasn't happened as soon, the move you wanted hasn't happened as soon as you want it to. If you did your analysis correctly, your stock will respond, but sometimes it takes a little longer than you'd like it to. I just went out with a big call a couple of days ago, and the market is not doing what I would like it to do. but it also hasn't violated any of the parameters that I set up initially when I put it on to suggest that I'm wrong. It just hasn't happened to the day or two that I put it on. So I'm not going to let my head talk me out of it. I'm not going to let impatience talk me out of the trade. I'm either going to let the market prove me wrong, or I will stay with the trade until my idea plays out. And I think that's some of the best advice you can get, because it's so easy for your head to talk you out of doing something simply because it didn't happen as quickly as you would like it to happen. You have to have patience when you're a trader. And unless you're trading very short-term dated options that expire in a day, today, tomorrow, or in a few days, you need to let things play out, because there are things that occur in the market that you can't always anticipate. But if you set your parameters correctly and you've got your stop at the right level, then just because you buy here and price is here, but your stop is here, don't let that small loss talk you out, unless something has materially changed in which you reevaluate the idea of being in the first place. And you just say, okay, I'm going to get out for a very minor loss. But if it's impatience, that's the reason why you're getting out, because it didn't move as soon as you wanted it to. That's part of the maturity that comes as you progress as a trader, to understand that sometimes it just takes some time to do these things. So as long as the trade is not, let's say, long option related, where your long calls or puts, where each day that goes by, you lose a little time decay. And if you went with a 3-month option and 3 days have passed and the trade hasn't started working, that's not enough theta decay to have any meaningful impact on your trade. Then let things play out. And I really do believe that this is one of the most important things that I can teach you with my over 40 years of experience of trading on Wall Street at some of the highest levels of trading at some of the best firms on Wall Street, and being a strategist at some of the best firms on Wall Street, and trading myself as I do. You have to have patience. Excuse me. Excuse me. And if you're the type of person who doesn't have patience, just it's not your general nature to have patience, then short-term trading is probably not a good thing for you to do. Invest for the long term, that's fine. But if you're sitting there, tapping your desk and staring at your screen and going, come on, then maybe you should consider not short-term trading. But if you're in the world of short-term trading and you expect, you're putting something on for a few days, a few weeks, but not necessarily for months, that would be more for investing. But if you're in the shorter term, you've got to have some patience for things to play out. So that's my thought for this week. I hope you take this to heart and you think about it. And I'll be back again shortly with a new In the Know Trader video. I'm Rick Bensignor, and thanks for watching.